G'day Gain Squad, I'm your host at Goldie Gains, and today we are looking back at the wildest ride in modern market history. Let's see where the smart money is flowing today, as we dig through the wreckage and the riches of the great financial crisis. In this episode, we are tracking the massive moves of gold, silver, and copper from the boom of 2006 to the peak of 2012. We will cover the drama of the Lehman Brothers collapse, the stimulus bazookas from central banks, and the global macroeconomic fallout from the US to Australia. Plus, we'll look at the famous legends who called it perfectly and the big banks that were left scratching their heads when the market went pear-shaped. Now, just a quick disclaimer, gold getters. This script is for entertainment and education only, not financial advice. Don't go betting the farm without doing your own research. Here is the main big question for you all. Based on the patterns we are seeing right now, will the cycle happen again in 2026? Tell us what you reckon in the comments. Smash that like button and subscribe to join the Goldie Gains crew for more golden insights. Let's wind it back to January 2006, when the world was flat out like a lizard drinking, fueled by the massive China urbanization miracle. Copper was the ultimate indicator back then, known as Dr. Copper, because it was the only metal with a PhD in predicting the health of the global economy. By May 23, 2006, copper prices entered a full-scale panic, skyrocketing 44 cents in one day to hit $4.08 per pound. Speculators were fighting a battle of nerves, while gold and silver were just starting a massive bull run that would change the world of finance forever. Gold was averaging around $604 per ounce in 2006, while silver was a bargain at $11.55. Traders were seeing the US dollar start to wobble, and the smart money was beginning to move into hard assets to hedge against the coming storm. By 2007, gold had gained over 31%, hitting $841, as the US housing market started to smell like a dead dingo. The market's having a bit of a wobbler in early 2008, as the subprime mortgage mess turned into a full-blown global catastrophe. In March 2008, the investment bank Bear Stearns teetered on the brink of total collapse before being rescued in a desperate midnight deal. On March 14, 2008, gold did something legendary. It breached the $1,000 per ounce mark for the first time in history. Traders were cheering in the streets, but that peak of $1,011 was just the calm before the most violent storm of our lifetimes. Silver had also surged to over $20 an ounce, and for a moment, the gold getters thought they had found the ultimate get-out-of-jail-free card. But then came Monday, September 15th, 2008, the day Lehman Brothers filed for bankruptcy and the global financial system seized up. You'd think gold would skyrocket during a bankruptcy that big, but instead, it did a massive belly flop as the dash for cash began. This is what happens when everyone is panicking. Hedge funds get smashed with margin calls, and they sell anything they can to raise liquidity. Because gold was one of the few things people actually had a profit in, it became the primary source of cash for a bleeding financial system. Gold plummeted from its March highs and bottomed out at $692.50 on October 27, 2008. Copper's collapse was even more terrifying, crashing from over $4 in July to just $1.25 within 6 months. That is a 70% evaporation of value, showing that when the global economy stops building, Dr. Copper gets very sick very fast. But don't sweat the dip, just more room in the pouch, because this was actually a proper golden entry for those with enough courage to buy. Famous investor John Paulson, who made $15 billion shorting the housing market, moved his profits straight into the gold market. Paulson wasn't just buying bars, he was looking for the smart money play by investing in mining stocks in stable spots like Alaska and Idaho. He correctly predicted that the Federal Reserve's response to the crisis would eventually lead to a massive devaluation of the US dollar. Then we have Ray Dalio, the founder of Bridgewater, who accurately forecast the excess leverage in the mortgage sector before it blew up. During the crisis, Dalio went long on gold and commodities, resulting in a 9.5% gain in 2008, while his rivals went bust. Dalio still defends gold as the safest money and recommends a 10 to 15% allocation to protect against a breaking monetary order. Not everyone was so lucky. Many analysts at big banks, like Goldman Sachs, were caught off guard by how deep the initial gold sell-off went. Peter Schiff was another big voice who correctly predicted the crash, but he was a bit early on his call for gold to hit $5,000 by 2013. While Schiff was right about the why, the when is always the hardest part of the game for even the most legendary traders. Commodity guru Jim Rogers was also doubling down, telling everyone to buy silver because it was cheaper relative to gold and had more room to run. Rogers has a core philosophy: buy when there's blood in the streets, even if the blood is your own. And Struth, there was plenty of it in 2008. Central banks eventually stepped in with the stimulus bazooka, launching quantitative easing and slashing interest rates to near zero. The US Federal Reserve essentially removed the opportunity cost of holding gold, making it the most attractive asset in the room once again. This massive injection of liquidity was like throwing petrol on a campfire for gold and silver prices as we moved into 2009. By March 2009, gold was back above its pre-crisis levels and starting a march toward new all-time record highs. The recovery was swift. Gold closed 2008 at $870, remaining flat during the worst year for stocks in decades. Silver also staged an explosive comeback, rising from a low of under $9 to nearly $50 an ounce by early 2011. This was the era of easy money, and the gold getters who held through the October panic were now seeing triple-digit returns on their positions. Let's look at the global impact, starting with China, which launched a 4 trillion renminbi stimulus package, about 13% of their GDP. This stimulus bazooka focused on infrastructure and housing, which single-handedly saved the copper market from total ruin. The People's Bank of China also realised that relying solely on the US dollar was a bad bet and started quietly hoarding gold reserves. They went from net sellers to buying 544 tonnes by 2012, shifting the centre of gravity for the gold market to the east. Down under in Australia, we had an absolute ripper of a time during the mining boom as commodity prices surged to record levels. Mining revenue as a share of our GDP jumped from 6% to 14%, reinventing cities like Perth almost overnight. However, this led to a textbook case of Dutch disease, where the record-high Australian dollar crushed our manufacturing and tourism sectors. The Aussie dollar pair hit parity and beyond, making it hard for any other Aussie industry to keep their head above water. In Europe, things were much worse as they entered the Eurozone sovereign debt crisis, starting in 2010. Investors were terrified that the PIGS countries Portugal, Italy, Ireland, Greece and Spain might actually default and break the euro. This fear drove gold to a then all-time high of $1,921.17 in September 2011. In Europe, gold wasn't just a hedge against inflation. It was a survival hedge against the total collapse of their currency system. Japan had a different story, where the yen and gold moved in lockstep because both were driven by real interest rate expectations. When the global markets crashed, the carry trade collapsed, causing the yen to spike as a safe haven right alongside the yellow metal. Now, let's talk about the big banks like JP Morgan and Goldman Sachs and their behaviour during this chaotic 6-year window. By 2012, both banks were hiking their gold forecasts to $1,800 or more, finally catching up to the reality of the bull market. But there was a darker side. Years later, the US Justice Department would convict several JP Morgan traders for manipulating the metals markets. They were accused of spoofing, placing thousands of fake orders to trick other traders into moving prices in a specific direction. JP Morgan eventually paid a record $920 million penalty to resolve these claims of market rigging between 2008 and 26. This just goes to show, smart money, that the big end of town isn't always playing by the same rules as the rest of us legends. Let's look at who the winners and losers were across different industries when metal prices were hitting those dizzying heights. The obvious winners were the large-scale mining corporations that managed to survive the initial liquidity crunch of 2008. By 2012, the top 15 gold-producing countries were contributing over $78 billion directly to the global economy. The gold recycling industry also had an absolute blinder. providing 36% of the total global supply as people sold their old jewellery. If you were running a cash for gold shop in 2011, you were probably living like a king as everyone cleaned out their jewellery boxes. On the losing side, the jewellery industry got absolutely hammered because the raw material costs were just way too high for regular customers. People simply couldn't afford a gold wedding ring when the raw metal was costing $1,900 an ounce. The construction industry also felt the pinch, as the cost of copper piping and electrical wiring became a major budget killer for new projects. Electronics manufacturers like Apple and Samsung were also squeezed, as high copper and silver prices pushed up the cost of every circuit board. But as we know, all good things must come to an end, and by 2012, the Great Gold Rally was starting to look a bit tired. The price gain in 2012 was only 5.4%, which was the smallest increase since the crisis began 4 years earlier. Investors were becoming complacent, as global growth started to look benign, and the major macro risks seemed to be under control. The Federal Reserve signalled they might finally wind down their stimulus programs, which caused a bit of a panic among the remaining gold bugs. Gold eventually entered a multi-year bear market that lasted until 2015, proving that even the best insurance policy needs a breather. But look at where we are now. Fast forward to today, March 31st, 2026, and the numbers are absolutely eye-watering. Spot gold is currently trading at $4,607.55 per ounce, a massive jump from the 2008 levels. Silver is sitting at $73.11, while copper is holding firm at $5.52 per pound. The US dollar index, or DXY, is sitting at 100.37, continuing its inverse dance with the precious metals complex. The Aussie dollar versus the greenback is at 0.686, showing we are still feeling the pressure of global economic shifts. JP Morgan remains bullish even in 2026, recently raising their gold outlook to a range of $6,000 to $6,300. They cite the same factors we saw in 2008: geopolitical risks, inflation surprises, and the need to diversify dollar exposure. Ray Dalio is also back with a fresh warning for 2026, suggesting we are entering a capital war that could eclipse the 2008 crisis. He argues that the global systems that keep money flowing freely are breaking down, which could lead to a massive repricing of all real assets. Peter Schiff is also pounding the table, saying the next crisis won't be about private debt like mortgages, but a loss of confidence in the US government. He believes that gold and silver are the only things that will survive a sovereign debt collapse, calling them the harbingers of a brewing storm. Struth. It feels like we are watching the same movie happen all over again, just with much bigger numbers on the screen this time around. The lesson from the 2008 cycle is that volatility is just the price of admission if you want to capture the big gains. You have to have the courage to buy when everyone else is screaming systemic collapse, and the patience to hold when the markets have a wobbler. Real interest rates are still the godfather of the gold price when the bank pays you less than inflation. The shiny stuff is going to shine. And remember that Dr. Copper is always the storm warning bird for the industrial side of your portfolio. If copper starts tanking while gold is still high, you know there's industrial trouble brewing in the world's manufacturing hubs. We've seen how the China miracle saved the day last time, but with their growth slowing down, who will fire the stimulus bazooka this time? The US debt is now over $38 trillion, which makes the 2008 debt levels look like pocket change. This is why the smart money is still piling into physical metals and miners, just like Paulson and Dalio did when the world was ending back then. Whether you are a gold getter holding physical coins or a trader playing the futures, the history of 2008 is your ultimate playbook. It shows us that even safe havens can drop 30% in a panic, but the recovery is where the real generational wealth is made. Don't let the noise of the media distract you from the long-term structural trends that drive these markets. As John Paulson said, the more we researched the market, the more our conviction increased, and that's the secret to staying legendary. This is a proper golden entry for anyone willing to learn from the past and prepare for the volatility of the future. We've covered a lot of ground today, from the collapse of Bear Stearns to the record highs of 2011 and the current state of 2026. We saw how the dash for cash can temporarily knock down even the strongest assets, creating opportunities for the brave. We tracked the behaviour of the big banks and the manipulation that sometimes happens behind the scenes of the world's exchanges. And we looked at the winners in mining and recycling versus the losers in the jewellery and construction industries. It's been a wild ride, and the rhymes of history are sounding louder than ever in the current global macro environment. The drama of Lehman Brothers might be long gone, but the debt and currency issues they left behind are still very much alive. So, Gain Squad, keep your eyes on the US dollar index and the central bank gold buying trends as we head into the second half of the year. There is always more room in the pouch for those who stay disciplined and wait for the right setup to emerge. The markets might be having a bit of a wobbler, but for the gold getters, that just means it's time to optimize the entry. To recap, we saw gold hit $1,000 in 2008, crash 30%, and then soar to over $1,900 by 2011. We watched silver go from $9 to nearly $50, and copper crash 70% before a massive recovery fueled by China. We learned that the dash for cash is a normal part of a crisis and shouldn't be a reason to panic if you're holding for the long run. We saw legends like John Paulson and Ray Dalio use macro signals to make billions, while others were losing their shirts. We compared the mining boom impacts in Australia to the sovereign debt nightmares that played out in the Eurozone. We looked at how central banks used quantitative easing to debase currencies, making gold the ultimate store of value. And we looked at the current prices of gold and silver in 2026, showing the incredible power of holding hard assets through the cycles. Now, I want to hear from you legends. Is the 2008 script being rewritten right now for a massive move? Will the cycle happen again in 2026? Or is this time actually different? Drop your predictions in the comments below, smash that like button, and subscribe to Goldie Gains so you never miss a ripper of a deep dive. Keep your positions tight and gains golden. I'll see you at the next close. Cheers.